Two people checked their 401k this morning. The first one, let's call him your coworker who won't shut up about it, is up 92% this year. He owns Nvidia. He's been telling everyone at the office that AI is the future and that if you're not all in, you're an idiot. The second person is you. You did the responsible thing. You bought a boring, diversified S&P 500 index fund years ago. You don't pick stocks. You don't watch CNBC. You're a sensible adult. And your account is also up, just less. And here's the part nobody tells you. You own Nvidia too. You probably own a lot of Nvidia. You might own more Nvidia than you do of 400 of the other companies in your diversified fund combined. You just didn't know it. My name is Nick, and I've spent way too much time pulling apart the math behind what's actually happening in this market versus what people think is happening. And if you want to understand why the smartest investors alive are quietly stepping back while everyone else celebrates record highs, make sure to subscribe and hit the like button, because today we're going to break down what is actually going on and why most people are about to get caught completely off guard. This isn't a story about whether the market is going to crash. Stocks crash. That's not interesting. This is a story about the fact that you own 7 stocks and you don't know it yet. Let's start with what's actually happening, because the headlines are confusing on purpose. And as of right now, the S&P 500 is sitting near an all-time high. The NASDAQ is at record levels. The Dow just punched back above 50,000 points. If you've been quietly putting money into your retirement account every month, you are winning. Genuinely, congratulations. But here's what most people get wrong. They look at the index going up and assume that means 500 American companies are all doing great. They're not. Out of those 500 companies, 7 of them now make up roughly 35% of the entire index. Just 7: Nvidia, Microsoft, Apple, Alphabet, Amazon, Meta, Tesla. Add the next 3 biggest names and you're at almost 38% of the entire S&P 500, sitting in just 10 stocks. To put that into something you can actually feel, in 2016, those 7 stocks were about 12% of the index. Today, they're 35%. The math has nearly tripled in less than a decade. So when you buy a diversified S&P 500 fund, you're not really buying 500 companies. Like, you're buying 7 tech stocks with a 493 company hedge sprinkled on top for decoration. And in 2025, those 7 stocks were responsible for 42% of the total returns of the entire index. So far this year, Nvidia alone has contributed about 1/5 of all the gains. One stock, 1/5 of the entire market that your retirement is sitting in. So when I tell you that you own 7 stocks and you don't know it yet, I'm not being dramatic. I'm being literal. Pull out your phone, open your 401k right now. I'll wait. If your top holding says anything like Vanguard 500, Fidelity 500, an S&P 500 index fund, or any target date retirement fund, congratulations. You're an Nvidia shareholder. You're a heavy Nvidia shareholder. Did you choose that? No. The math chose it for you while you were sleeping. Okay. So we have a concentration problem. That alone isn't fatal. Concentration only matters when something cracks. So the real question is, how expensive have these things actually gotten? And this is where the math is screaming. There's a way that economists measure how expensive the stock market is. You don't need to know the technical name. All you need to know is that this number tells you on average how many years of company earnings you have to buy to own $1 worth of stock. Historically, since the year 1880, that number averages around 17. Today, in May 2026, it's almost 40. The only time in 145 years of US stock market data this number has been higher was December 1999. Right before the dot-com bubble lost roughly 80% of its value over the next 2.5 years. Even in 1929, the year of the Great Crash that triggered the Great Depression, this number was 32. Today, we're at almost 40. We are statistically in the second most expensive stock market in American history. There's another way to measure this. You take the total value of every public US stock and divide it by the size of the entire US economy. Basically, are stocks worth more than the economy that produces them? Today, that number is 231%, an all-time record. Before the 2000 crash, it was 146%. Before 2008, it was 109%. Today, US stocks are valued at more than twice the size of the entire US economy. That's like a single restaurant being worth more than the entire neighborhood it operates in. At some point, the math has to bend back. So why are stocks this expensive? One reason, AI. And here's the part where it gets actually insane. The entire bull case for the market right now rests on this single bet that artificial intelligence is going to deliver such massive productivity gains that it justifies paying record prices for everything. Maybe it will. Honestly, maybe it will. But let's look at how much money is being spent betting that it does. In 2026, just 4 companies, Microsoft, Google, Meta, and Amazon, are planning to spend roughly $725 billion on AI infrastructure, data centers, NVIDIA chips, cooling, electricity, the whole thing. That's a 77% increase from last year, which itself was a record. $725 billion from 4 companies in 1 year. To put that in perspective, that's more than the entire annual GDP of Sweden, 4 companies, 12 months, spending an entire developed country on data centers, and that's just 1 year. They're planning to keep going. Now, here's the thing about that spending. It's already starting to eat the cash flow alive. Amazon is on track for negative free cash flow this year, somewhere between negative $17 and negative $28 billion, depending on whose math you use. Translation, Amazon is now burning cash just to keep up with the AI race. Microsoft's CFO admitted that $25 billion of their spending this year is just chip and component price inflation. Meta got punished in April when it raised its AI spending guide and the stock dropped 6 to 9% in a single day. That's the first time investors have meaningfully pushed back. But here's what nobody wants to talk about. The whole AI economy is starting to look like a snake eating its own tail. Stay with me. NVIDIA announced a $100 billion pledge to OpenAI. OpenAI then turned around and signed a $300 billion contract with Oracle for cloud computing. Oracle is now raising $45 billion to fund the infrastructure needed to deliver that contract. AMD gave OpenAI $34 billion in stock warrants. NVIDIA is financing a company called CoreWeave, and what does CoreWeave do? It rents out NVIDIA chips. It's not even subtle. These companies are essentially writing each other checks and counting it as revenue. And here's the actually wild number. OpenAI has committed to roughly $1.4 trillion in spending over the next 8 years. Their current revenue? About $13 billion. So that's like signing a 30-year lease on a $4 million mansion while making $36,000 a year and just assuming you'll figure it out before the rent's due. Now, in defense of the AI bulls, maybe they will figure it out. The cash flows at Microsoft, Google, and Amazon are real. They're not pets.com. But here's the receipts check. MIT recently published a study looking at 300 real-world corporate AI deployments. The finding? 95% of organizations studied are seeing zero return on their AI investments. Not low return. Zero. So right now, we're spending close to $1 trillion a year on a technology where 95 out of every 100 corporate deployments aren't generating measurable returns. Eventually, the people writing those checks are going to want to see the receipts, and when they do, the math is going to have a conversation it doesn't want to have. Okay, take a breath. Because we haven't even gotten to the macro yet, and the macro is where it gets dark. Here's the thing about expensive stocks. They're only justifiable if everything else is going right. So let's check on everything else. April inflation came in at 3.8% year over year, highest in almost 3 years. The Federal Reserve, which 6 months ago was expected to cut interest rates 3 or 4 times this year, has officially taken cuts off the table. At their last meeting, they voted to hold rates steady, and the vote was 8-4. The Fed publicly argued with itself for the first time since 1992. That's not a small thing. That's the closest thing to institutional chaos the Fed ever shows in public. And right now, the bond market is pricing in roughly a 37% chance of an interest rate hike by the end of the year. Hike, not cut. 6 months ago, we were all expecting rate cuts. Today, Wall Street is starting to bet on rate increases. That's a massive vibe shift in a very short period of time. Oh, and Jerome Powell, the guy who's been running the Fed since 2018, his term ended in May. He's been replaced by Kevin Warsh, who is widely seen as more aggressive on inflation. So we have a new sheriff, a stickier inflation problem, and a market priced for absolute perfection. Cool. Cool, cool, cool. Meanwhile, the 30-year Treasury yield just hit 5.19%, the highest level in roughly 19 years. Why does this matter for stocks? Because when you can lend money to the US government and get paid 5% with no risk, paying 40 times earnings for a stock with all the risk in the world starts to look a little silly. Bond yields are gravity, and gravity just got heavier. And then there's the debt. The federal deficit is on pace for $1.9 trillion this year. The national debt is over $38 trillion. The interest payment alone on that debt is now over $1 trillion a year. That's right. We are paying more in interest on our own debt than we spend on the entire United States military. Ray Dalio, who runs the largest hedge fund on the planet, recently called this an actual debt death spiral. Direct quote. When the guy with $150 billion under management uses the phrase debt death spiral, you don't have to agree with him, but maybe just write it down. And here's where I need to rehook you, because we still haven't gotten to the cockroaches. I'm not joking. Cockroaches, let me explain. Remember 2007? Right before the housing crash, there were these little tremors, like a subprime lender here, a weird hedge fund failure there. Nothing big enough to make the news for more than a day. But in retrospect, they were the warning shots. Well, we have those right now. And nobody is paying attention. In the last 6 months, 3 random companies you've never heard of have already collapsed and taken hundreds of millions in bank losses with them. A subprime auto lender called Tricolor filed for bankruptcy, and it turned out the executives had been pledging the same collateral to multiple lenders at the same time. The Department of Justice charged them with fraud. JP Morgan ate a $170 million loss. Fifth Third Bank lost about $200 million from one company nobody had heard of. Then an auto parts company called First Brands collapsed with over $10 billion in debt. Turned out they'd been using off-balance sheet financing to hide how leveraged they really were. Lenders thought the company was leveraged 5-1. Reality was 20-1. Several big lenders took losses of $500 million or more. Then 2 regional banks, Zions and Western Alliance, both disclosed bad loans tied to the same fund family. The whole regional bank index had its worst day in over a year, and this is when Jamie Dimon, the CEO of JP Morgan, the biggest bank in America, said on camera, quote, "When you see one cockroach, there are probably more." The CEO of the largest bank in the United States publicly compared the credit market to a cockroach infestation, which is, a pretty bold metaphor coming from the guy whose entire job is to make the system feel calm. So if you're keeping score, stocks at record valuations, concentration in 7 companies, AI spending, that resembles a Ponzi diagram, inflation refusing to die, the Fed pivoting from cuts to potential hikes, government debt eating itself, and credit cracks showing up in places nobody was looking. So what are the smartest investors in the world actually doing about it? Because if it were just me, one guy on YouTube, yelling about valuations, you could safely ignore me. The thing is, basically every legendary investor alive is currently positioned defensively. Let me run through them because this part matters. Warren Buffett, the most famous investor of all time, just stepped down as CEO of Berkshire Hathaway. Berkshire is sitting on a record $397 billion in cash. That is more than 30% of their total assets just sitting in cash. The highest percentage in at least 3 decades. At the May annual meeting, he told CNBC, quote, "I don't see the ideal investing environment." Michael Burry, yes, the guy from The Big Short, the guy who actually shorted the 2007 housing market, he just said, and I'm quoting, "Feeling like the last months of the 1999-2000 bubble." He's bought put options betting on a 30% decline in semiconductor stocks. His portfolio shows almost $1 billion in bets against Palantir alone. Jeremy Grantham co-founded a firm called GMO, has called every major bubble of the last 50 years correctly. He said this in May, quote, "There will be blood in the streets." John Hussman manages a major fund. He recently said, quote, "If there's any point in US stock market history next to the market peaks of 1929 and 2000 that has deserved a timestamp of speculative euphoria, now is that moment." His models imply a possible drop of 63%. Not 6%, 63. Stanley Druckenmiller, legendary hedge fund manager. So in late 2025, he quadrupled his stake in Alphabet. 3 months later, in early 2026, he sold every single share, the entire position gone in 1 quarter. He also cut his Amazon stake by 94%. When this many investors who have made their entire careers being early but right are all stepping back at the exact same moment, that's not nothing. That's a signal. And here's the part that should make you genuinely uncomfortable. In November, Bank of America did a survey of professional money managers. 53% said, yes, AI is a bubble. 20% net said, companies are over-investing in AI, the first time that's been true since 2005. The price-to-book ratio of the S&P 500 hit a record 5.3, even higher than the dot-com peak. And Bank of America's chief strategist summed it up in 9 words, quote, "The top is a process. The bottom is a moment." Sit with that for a second. The top is a process. The bottom is a moment. In other words, you don't get a clean warning. The top doesn't ring a bell. The party drags on for months or even years. People get richer. They get cockier. They post their gains on social media. They tell you you're an idiot for being cautious. And then one Tuesday morning, the bottom isn't a process. It's a moment. And everyone who was waiting for the perfect time to get a little defensive missed the window because they were too busy enjoying the ride. So here's why most people aren't ready. And it has almost nothing to do with whether they think a crash is coming. Most Americans are now passively invested in S&P 500 index funds. That's been sold for decades as the safe, boring, sensible move. And historically, it absolutely has been. But because of how index funds work, when 7 stocks are 35% of the index, your boring passive index fund is now an active, concentrated tech bet. You didn't choose that. The math chose it for you. You own 7 stocks and you don't know it yet. If Nvidia drops 50%, your boring index fund drops with it. On top of that, Americans have now borrowed $1.3 trillion to buy stocks, the most in history, nearly 3 times the historical average. So when I tell you we're in the most leveraged, most concentrated, most expensive stock market in modern history, that's not a metaphor. That's just the number. And half of all stock options trading volume right now is people buying lottery tickets that expire the same day they buy them. We are absolutely degenerate gambling our way into a market top. So look, am I telling you to sell everything tomorrow? No, genuinely no. Timing the exact top is a loser's game. Bears have been bearish since 2023 and they've missed a 130% rally in the NASDAQ. Paul Tudor Jones, who's no slouch, said in May that we might still have 2 more years of upside before any real reckoning. Markets stay irrational longer than you stay liquid. That's an actual rule. But what you can do is be honest with yourself about what you actually own. If your portfolio is 100% S&P 500, you are not diversified. You are concentrated in 7 AI stocks with a 493 company hedge. If you're invested on margin, you are betting the music keeps playing. And the music is louder right now than it's been in decades. If your strategy is, I'll just sell when things start to look bad, please understand, you won't. Neuroscience is brutal on this one. People do not sell into euphoria. They buy into it. People do not buy into fear. They sell into it. your future self is not going to be smarter than your current self. Your future self is going to be exactly as scared as everyone else. What you can do is boring stuff. Boring stuff. Look at your allocation. If you've drifted way overweight tech, rebalance. Consider equal weight S&P funds. Consider international exposure. Consider bonds. Honestly, consider cash. Cash currently pays you almost 4% risk-free for doing nothing. Warren Buffett is holding $397 billion of it. You're allowed to hold a little. Don't try to be a hero. Don't try to nail the top. Just don't be the last one standing when the music stops, because the top is a process. The bottom is a moment. And right now the process is still playing out. The market is still climbing. Your coworker is still winning. The headlines are still optimistic. The vibes are still good. That's exactly what the late stage of every bubble in history has looked like. That's exactly what 1929 looked like in early 1929. That's exactly what 1999 looked like in early 1999. That's exactly what 2007 looked like in early 2007. You don't get to choose whether the moment comes. You only get to choose whether you're holding the bag when it does, and right now, whether you know it or not, you're holding 7 of them. Anyway, that's where we are. If you got something out of this, hit the like button, hit subscribe, and let me know in the comments what your top 3 401k holdings are. Bet you're going to find at least one of those 7 stocks in there. Just a reminder, I am not a financial advisor. This video is for educational purposes only. Any decisions you make are entirely your own. I'll see you in the next one.